Hello, everyone, and welcome to another great webinar from CPA Academy. Thank you for joining us today. My name is Gabe, and I'll be your moderator for today's webinar, Cost Segregation Essentials, High Impact Tax Planning for CPAs. Our presenters today are Eric Tuthill and Mark Wober. Before we get started, I wanted to go through some housekeeping items and do some technical checks just to make sure everything is working. First, if you don't mind going to the Q&A tab on your control panel, and please let me know if you can hear my voice and see the title slide. Feel free to let us know one thing you'd like to learn from today's webinar. If anyone has any technical issues, please let me know in that Q&A tab, and I'll get to everyone as quickly as possible. This is also where you can post your questions and comments for our presenters. And I see him coming in from California, from Florida, New Jersey, Iowa. Thank you. So now that we know everything is working, let's go through some housekeeping. This webinar qualifies for 1 CPE credit or 1 CE credit. CPE credit will be available within 24 hours in your CPA Academy account. And for attendees with a P10 on file, we will upload your CE to the IRS at a later date. You'll earn that credit by staying logged in for 50 minutes and answering the poll questions. There will be 4 polls today, and to earn credit, you'll need to answer at least 3 of them. I also wanted to let you know that we're recording today's webinar, and the archive, along with your credit, will be available in your CPA Academy account within 24 hours. And if you have to log out or log back in for any reason, the webinar software will keep track of your time. We also recommend you download today's presentation materials, which can be found in the control panel's handout tab. So now that we're all set, let's welcome our presenters. Eric and Mark, the floor is all.
All right. Well, thank you very much for the introduction, Gabe. I want to go ahead and just kind of give a little bit more of an intro of who I am. My name is Eric Tuthill. I'm a tax director here with Corporate Tax Advisors, and I'm a CPA and also have a master's degree in accounting. And prior to joining Corporate Tax Advisors as a tax director, I owned my own firm for a couple of years, built it up, and then sold it. So I do understand where a lot of folks are coming from here today on this webinar, and we'll try to do my best here to look at it from your perspective as you're dealing with your taxpayers and with your clients as we go through this process. So, coming from that perspective, the way that I decided to look at what this presentation would cover is I decided, like, what kind of questions would I ask if I'm a CPA trying to learn what this function is and how we can use this for tax planning. And I would say to myself, one of the first questions I would ask myself is, how much does cost segregation actually save taxpayers? So if I was to actually learn and apply this particular type of tax planning opportunity, how much money would that actually save? And that's what a lot of folks want to know, and what your folks want to know, and your clients want to know, first and foremost, is how much money is this going to save me? And then secondly, I'd want to know a little bit more about how does cost segregation work? And I'd want to know some of the intricacies with it, some of the specific kind of court cases, things like that would validate this particular type of study. And then, some of the history around it, and just kind of how it would operate in from a functional perspective, and how we will be able to kind of deliver that to the client and actually get it out the door. And then take full advantage of what the cost segregation study can do. And then lastly, I'd want to know, who does this fit? Like, how do we identify appropriate taxpayers, and how do we plan that to the most appropriate advantage for these taxpayers, right? And so that's how essentially this presentation is broken out. And with that being said, I know we're going to get into, and this is kind of one of my first times doing this, so I know that there's going to be a polling question here right now. And before we get right into this topic, it should hopefully apply somewhere on the side of the screen.
We're going to go ahead and get that first poll launched. It has been launched for our attendees. If anybody needs any assistance, I'm available in the Q&A. Right back to you, Eric.
Okay, great. So this is the first question, and that's, how much does cost segregation save taxpayers? So the first thing I think we got to do is just kind of lay the groundwork for what cost segregation really is. I know this isn't necessarily that section, but I think we need to kind of lay that groundwork. And a lot of folks here are probably familiar with accelerated depreciation and bonus depreciation and maximizing that for taxpayers. And a lot of us know about how we can say take depreciation on a vehicle and kind of push that vehicle and make taxpayers happy by showing them, hey, we're taking all of these losses, all of these deductions in this particular tax year by using this the 168K, right? That bonus depreciation amount. Well, what cost segregation does is it identifies very particular property within a commercial property, so like or a commercial or residential real estate property, right? A 27.5 or a 39-year property, and it identifies what the shorter lived assets are that are associated with that, and that would be, say, 15-year property for land improvements and 5-year property for tangible personal property that may be attached to that particular real estate property, right? And what it does is it basically breaks those out, right? That 39-year property, and it gives it that shorter life and makes it eligible essentially for bonus depreciation. And I know that a lot of folks will look at this and they're going to say, hey, this does represent a timing difference. But if you utilize this appropriately, not only do you not just have that timing difference that you might have to pay the piper eventually on, you might actually have to pay gains on 1245 and all that other stuff, but you can stack it with other types of incentives and strategies. And say you can couple that with, say, a section 1031 exchange and roll that into a more basis a little bit further on. There's a lot of things that you can do to still take advantage of this specific timing difference. And I think most of us know that the taxpayers really, they value just seeing that the current tax year. They don't really necessarily look into the future, and it's not always about what the future offers in terms of deductions. They want to know what they can get now and how they can reduce their tax issues right now. I know a lot of folks here probably have extended tax returns, and they might have had a particular tax due prior to April 15th, right? And this particular tax strategy offers an excellent opportunity to reduce that tax due that might have been in April 15th. It's basically an opportunity to go and fix some of the things that we might have had that tough conversation with clients at the earlier part of the year. This gives that unique opportunity to go ahead and address that and get them out of a sticky situation in the current tax year. So one of the things that when we're performing a cost segregation study, we like to use, say, a rule of thumb, right? And it's all about how much cash flow we can free up by reducing tax liability for that particular tax year. And that rule of thumb is generally going to be between 5 and a lot of times it's 10% plus of building basis to immediate to near-term cash flow. So that's the rule of thumb that you can essentially use. You take that basis of whatever you've got on the depreciation schedule, and you can apply that type of percentage to it, and that's roughly going to be what the cash flow is going to be, or the savings is going to be for that particular taxpayer. And I say that's the tax liability, not necessarily the deduction, right? The deduction is usually a lot higher, and then that's tax affected at 30%. And of course, there's this thing at the back of all of our tax returns there, the 8582, that passive activity, that passive activity form that we all know and love. And, it really is dependent upon how we kind of are classifying things and how we're looking at how the taxpayer works within the realm of all the things that they've got going on, and whether or not they're going to be able to actually use this. Because otherwise, sometimes things can get stuck in that passive activity sheet, and it can get carried forward indefinitely until that actual activity has any income, or till it actually gets sold and released, right? And so we want to make sure that we have things like passive income to offset, or we have other exceptions that are out there, say real estate, professional classifications, or grouping activity elections that we can make that are actually going to maximize this for your taxpayer and allow them to offset, say, active income or other income that they might have elsewise, right? The other cool thing about this is that it can be used on properties that are already purchased in a portfolio. So I know a lot of us have, and I remember back in my private practice days, I would have like at least 10 or 15 clients I could think of off the top of my head that had 10 or 15 residential rental properties, or had a bunch of different types of commercial properties. and they were in a nasty tax situation in that particular tax year. You'd call them up and you'd say, hey, I think this year you owe about $40,000, and they would freak out on you, and you would do your best to kind of to wind that back and try to calm them down and say, well, the good news is you earned a lot of money this year, right? And they didn't like that. I'm just going to be honest with you. And so you got to look, you say, okay, well, let's extend your tax return. Let's take another look. And you're looking through their tax return and you see, hey, we've got these depreciable assets they've got like 10 rental properties. Well, maybe what we can do is do a couple of cost segregation studies and accelerate that to this particular tax year and use that to get rid of their tax liabilities using a 481A adjustment and a change in accounting method. That's one of the cool, unique aspects of cost segregation. So with that being said, those are the basics here. And let's just go ahead and go into how much, like an example of essentially how much cost segregation saves taxpayers. And with that, I'm going to go ahead and hand it over to Mr. Mark Weber, our senior cost segregation manager, and he's going to go through what that example looks like.
Yeah, hey everybody, thanks for joining us today, and thanks Eric for the intro. Like you said, I'm Mark Weber. I'm working in our cost seg department here at CTA, and so I'm a civil engineer by trade. But have some experience in the R&D tax credit and the 179D deduction as well. But yeah, let's look at a real world example here. So here we've got a $500,000 rental property, and so think maybe a small apartment building maybe. And so the first thing we're going to do is we're going to segregate out. Usually, typical rule of thumb is about 20% of the property value to land. So here that's going to be $100,000. Allocated to the land, leaving us with $400,000 for building value. And so without cost segregation, you're sitting on your long drawn out 27.5-year straight line depreciation schedule, right? And so that's going to be a first year deduction of just under $14,000, which, it's slow and steady, but it's really nothing to get excited about, right? And so now let's say we do a cost seg, and what we do is we reclassify that $400,000 into 3 specific buckets. And so the first bucket is going to be your section 1250 real property, or 27.5-year life. So think about the structure of the building, right? So the walls, the roof, the foundation. And so in this example, we show that $286,000 of that $400,000 is going to remain in the structure. And that's pretty typical. We always see most of the components of the building staying in the long life property bucket. But then we jump down to land improvements, or 15-year property. So again, think our paving, our landscaping. And so here in our example, we show about just right under $77,000 for land improvements. And then we jump down again to our third bucket, which is section 1245 personal property, or 5-year property. So think about your carpeting, your light fixtures, or maybe some specialized systems, right? And so in this example, we've got, it looks like $36,000 in there as well. And so, a good way to think about cost seg, at least this is how it was explained to me when I first started going, is think about picking up a building, shaking it, and turning it upside down. Everything that really stays with the building is going to stay with the structure. And then everything that falls out is going to be shorter life property, right? And so let's keep going here. Let's take a look. And so we assumed with this property that it was placed in service in 2025. And so that's going to leave us in the 40% bonus category. And so when we apply that to the 15 and 5-year components under our tax rules, the first year deduction already is going to reach about $62,000 and 61 cents. And so another thing you want to keep in mind here is we are still depreciating obviously the core of the building as well. And so of that $62,000, $45,354 is going to be those accelerated assets, right? And so, but if you take another look to the 100% side, we're looking at almost $115,000 if bonus goes back up to 100. So you take, again, all of that in the first year, which would be right at $123,000. So again, which is an absolute huge jump. And so, the big thing with this example is really just to highlight, you don't need to have, a massive property to do a cost seg. There's definitely value in doing a cost seg on any property. One thing I'd mention too, these are pretty average reallocation percentages for shorter life. So, typically we see 25, maybe 30%. So these numbers are even more. And so, when we assume a 30% tax rate, we're looking at savings of right at $15,000 in year one. And then with 100%, we're looking at just under $33,000. So again, cost seg, it doesn't have to be a big, massive, $20 million property. It really can be applied to any property. So let's jump over to the next slide. So this next one is a big commercial property. So it's a $10 million example. And again, we're going to assume this one was placed in service in 2025. So, let's just assume this might be an office building. And so again, we automatically are going to segregate out about $2 million of the land, and we'll have 8 remaining in the building. And so without cost seg, we're sitting on that 39-year depreciation schedule, which is going to come out to right at $280,000, which, is okay, but, it could be better. So let's see how cost seg affects this one. So again, with this example, it looks like 4.6 million is going to stay in that real property bucket. So again, that's the building's core, the structure, walls, concrete floors, roofing. And then we've got about 1.5 million allocated to land or 15-year property. So that's going to be parking lots, fencing, maybe some exterior parking lot lighting. And then we've got just under 1.8 million allocated to 5-year property. So that's decorative lighting, that's certain types of flooring, the list goes on. And so in total, cost seg was able to reclassify about $3.3 million of that 8 million to shorter life. And so with the 40% bonus, we're looking at taking about 1.3 million of that number in the first year. And so when we apply it to the entire property, the first year deduction is going to jump all the way up to 1.7 million, which is an almost $1.5 million increase than that original $280,000 depreciation number without cost seg. And so at a 30% tax rate, this increased deduction, delivers almost $500,000 in tax savings in the first year. And so let's say we jump back up to 100, and instead the first year deduction is going to be almost $3.5 million, which then we're looking at, almost $1 million in tax savings in the first year. And so the reason I kind of show these two examples is just to be like, hey, it can be applied across a wide range of properties, and it's a super powerful tool for properties that are in that $5, $10, $15 million range. And, even still that we're at 40% bonus, $430,000 in the first year is still a significant boost to cash flow, ideal for reinvesting, maybe buying new properties perhaps. And then with 100% bonus depreciation, it just makes this look even better at $1 million.
Yeah. And I would just like to say, really quick that, the 100% bonus depreciation, that is in the drumbeat of war there that Trump is kind of laying down in terms of what that likely legislation is going to look like, right? And so that has been a huge hot topic for them. And of course, as tax practitioners, we all know that 100% was extremely beneficial to our taxpayers. They really like that. And so the likelihood of that coming back here and actually starting once again, I know it came originally with the Tax Cuts and Jobs Act, but that the likelihood of that happening again is extremely, extremely likely, right? So this is going to be more likely what we're going to see. And if that legislation does come out, it probably will be applied to 2025 or January 2025 going onwards, right? So that's why we included this 100% here to kind of give you a little bit more of an idea of, say, if something was placed into service this particular tax year, this is the real kind of savings that we're expecting. Of course, there's a lot of things up in the air where it comes to this legislation, but that is kind of what we've been looking at. And, we were talking a little bit prior to this about how we might be in a tax situation where we've got a guy that owes like $40,000. Well, if we're looking at if we end up getting the 100% bonus depreciation, we've made a huge chunk in his tax bill, and we hit that, say like we hit the $32,830. If we get that 100% legislation, that's a huge chunk in his tax bill. But you can see the difference that bonus depreciation will make in terms of a cost segregation study. Going back to 2024, obviously the rates are higher, right? So instead of 40%, we've got 60%. And so if we're looking at properties that were placed in service, 24, 23, 22, right, where we got like a full 100% bonus expensing, we can still take advantage of that. And I know a lot of the times, we're used to not being able to take anything if it's over 3 years old. But in this case, because of how we can use specifically the 481A and an automatic change in method, we can take properties that are 5, 6 years old, and we can accelerate that depreciation into the current time period. So that's always crucial when we're trying to look at how we can use this from a tax planning perspective to mitigate the current year taxes that we're seeing from our taxpayers. Is there anything else that you'd like to add, Mark, on these slides?
No, that's it. I mean, you hit it on the head. Most of the properties that we deal with are already owned anyways. And so, we get a lot of folks that have, bought buildings in, 2020, 2021, 2022, that are still able to take advantage of that 100%. So it's very common.
Awesome. Well, that being said, I know we're about to enter into another polling question, so I'll hand it over to Gabe.
Thanks, Eric. Our second polling question has just launched for attendees. It'll be open for the next minute or so, so please get those answers in for us. I'm available in the Q&A if you need any assistance. Right back to you.
All right, so I think we've kind of answered the question roughly. How much money is this going to save our taxpayers, at least high level, so we know, hey, is this worth investigating? Is this worth utilizing this in a particular type of tax plan for our clients or for our taxpayers? But the second question that we need to answer for ourselves is, what's the legitimacy of cost segregation and how to work, from an overall perspective? And there's a lot of history actually that goes around cost segregation, and this stuff has been around for quite a long period of time. It's going to be most notable after essentially the Hospital Court of America versus Commissioner, right? That was where we were able to kind of redefine what certain properties were and being able to kind of categorize those particular properties. That was the landmark case, if you will, for cost segregation. But we've had a history of depreciation going back a long time. A lot of us might know, what 263A is off the top of our heads, right? And most of us would know that that's UNICAP. I remember I used to work for a bunch of mid-tier firms back in the day, and as working for these mid-tier firms, UNICAP meant a totally different thing to me, because I ended up having to capitalize a bunch of overhead costs or administrative costs for UNICAP purposes. But they changed the rules there with the Tax Cuts and Jobs Act, and so now we really kind of look back at that code and that particular code section for just the general rules of how we capitalize property, right? What is capitalizable, what isn't capitalizable? That was the basic kind of rule there. So 263A is the UNICAP code. Most of us are familiar with that. After that point, they did a couple of other types of classifications. We classified Section 1250 property and 1245 property, so we knew when we had to kind of reclaim any type of deductions that were taken from a depreciation end. It essentially kind of defined what that recapture looked like for real property, which is the 1250, and then tangible property, which is the 1245. Those things came about in the 50s and 60s. And then we had the Reagan era, right? And Reagan came out there with Section 168, and we had the makers classification, which kind of allowed us to, a lot of class lives were a lot higher back then, allowed us to kind of accelerate these things and classify them into little shorter lived properties, such as 5, 7, and 15 years, right? That's kind of where that really came about, was 168. Most of us are familiar with 168K, at least, as the bonus depreciation provision, but that's where a lot of the maker stuff is located, right? And then one of the really cool aspects of this, and we'll get into how this helps with planning, is this passive activity grouping Treasury regulation, 1.469-4, right? And how this particular grouping will help taxpayers not only classify themselves as real estate professionals, but also how taxpayers who say like a manufacturer that owns the building that they're in, whether or not that's in an LLC or not, and if they're doing a self rental kind of thing, and trying to protect that asset with some a legal entity between the two. Whether or not that's the case with this particular regulation, it allows us to essentially make an election that groups these activities together so that we can take that depreciation against active income. And that's one of the big tax strategies that's out there for cost segregation, is understanding that, if you own the building, or if you have common ownership between the building and the active trader business, you can group those activities together and take that depreciation, and maybe sometimes we would say excess depreciation, or depreciation in excess of whatever revenue that particular activity is producing, and take that against that active trader business income. That's one of the heavy tools in the arsenal here for cost segregation tax planning. So that came about there in 1992, and then in 1999 they came out with essentially a little bit more of a justification there for whether or not you can use cost segregation as a valid tax planning tool. And that really came about because of, and this is a little bit out of order here, that really came about because of the Hospital Corp versus America, Hospital Corp of America versus Commissioner, right? And in that particular court case, that's where we started saying, okay, well, we can classify some of the property that's within a building as tangible property. We can classify some of it as like land improvements, and we can classify some of it essentially as the building itself, right? And structural components of the building itself. So that's what set that actual precedent, right? And then we've got a couple of rev procs in here where we've got the automatic change procedures, right? And there was a couple updates to that. But essentially that allows us to say, take a vehicle, an asset essentially that was placed in service, say in 2020, right? And we know we're well past statute for a refund for that particular asset if we placed it in service in 2020, and accelerate it and put it into change our method of depreciation, saying essentially we messed up in the past, or we screwed up in the past, and we want to go ahead and fix that and catch up on all of the depreciation we should have had during that entire time period. So that essentially gives us that opportunity to go ahead and take that through a 481A adjustment and a change in accounting method. And it's an automatic change. So the 3115 is not as onerous as most of us are probably familiar with. But when you do this with the automatic change, you're able to take that deduction in the current time period, which is really helpful from a tax planning perspective, because we know that somebody has a property on their books, old property on their books. This might be the opportunity that they need, and they're facing a tax consequence. This might be the opportunity they need to go ahead and accelerate that and take that against that active income for this particular year. The other big thing here that I'm going to go through is just the IRS publication, the cost segregation audit techniques guide, right? Because that kind of defines, at least high level, what the IRS sees as a valid study or a reasonable study. And I know that Mark's going to get into that a little bit more in heavy detail a little bit later, but that's one of the big crucial things here that kind of talks about what is a valid study, what isn't a valid study. And we also know about the final tangible property regulations that came out. A lot of us were able to deduct $2,500. That's what I remember from that particular thing. I think it came out during the Obama years, but that allowed us to essentially take $2,500 of costs and just go ahead and expense it instead of going through and capitalizing it, as long as we attach that election at the back of returns. And I know a lot of folks are familiar with what that looks like, but that's essentially kind of what that did. And it also established specifically what a unit of property was and supports partial disposition. So, establishing, say, like an HVAC system where you can dispose of that later and put it in, and you can do like a partial disposition essentially with those particular regulations. That kind of gave a little bit more support for that stuff. And I think one notable exception here, I mean, a lot of folks here probably remember that we used to have, qualified leasehold improvement property. And through the Tax Cuts and Jobs Act, that went away, but then it also classified HVAC and other improvements to property as 20-year life, which made it ineligible for bonus depreciation. And that was a huge thing when that tax legislation got passed. And I think it took them 2 years to rectify it when they finally put that into the CARES Act, and they put in qualified improvement property as 15-year life, right? And so that allowed us to start accelerating that again. And that was one of the most kind of crucial things from that history perspective there. So with that being said, I'm going to go ahead and hand it over to Mark really quick again, and he's going to go through what this looked like, especially from the audit technique guide, and what makes a valid study, what doesn't.
Yeah, absolutely. And so, I guess the big thing over the years that's been changing, I think it's kind of cloudy what makes a cost segregation study reliable, right? You see a lot of things now, like maybe DIY cost seg, things like that aren't, as reliable as what the IRS wants. So the IRS recommends a detailed engineering-based approach. Now, again, cost segregation is not an engineering study. They just want an engineering-based approach. And that's what's outlined in Chapter 3 of of the audit technique guide. And so, the engineering approach, it really is the gold standard, to be sure that you ensure your study maximizes savings and holds up under IRS scrutiny. And so, you want these studies to be handled by engineers, maybe experts in construction or tax law, just ensuring that the accuracy and compliance. And so, and the other thing to consider is that, using folks like that will get you the biggest deductions every time while keeping your tax strategy secure, being sure that you yourself can be confident in the study. And so here are, a few things that make a study pretty ironclad. So the first step is, you want thorough documentation review, right? So you want a team that's going to dive into construction records, think final pay application, blueprints, different cost breakdowns, really trying to understand every detail of your property. And it can get pretty, it can become a lot, some of them they can be small homes or all the way up to, $70-80 million hospitals, right? And so you want to be sure that whoever's doing the study understands every single detail of the property and leaves no stone unturned, because they will find it if there is one. The next step is a site inspection. And so, this really separates a good study from a great study. The strongest studies always come from, engineers who go on site, visit the property, review plans, and confirm the assets are there, taking photographs and measurements. And one thing I'd also like to highlight is, in the few audits that we have experienced, the very first question the agent asked was there a site visit and who did it? And so that's something that is very important to the IRS and very important to ensure that you have a study done the right way. And then the next is asset classification. So, every component in a cost seg study is sorted into the correct makers category, like we were talking about with the example. So that's going to be every asset separated into 5, 7, 15, or 39-year property. And so, and again, we have to distinguish what's personal property, what is real property, what's land improvements, right? And so that all has to be clearly outlined in the study. Another thing that makes a study good is when you cite different types of citations, right? So, you could go into the section 1245 and 1250 rules. If you want some legal support as well, you can look at, the hospital Corp of America case. And you can also include some IRS guidelines in there to ensure some compliance. But last but not least is you want clear documentation, right? And so you want to show what, method that you're using. So something that you can use that we'll get into is the cost approach, or maybe the unit in place method to assign values. And just be sure you document every step for complete transparency. And so go ahead and go on to that next slide for me, Eric. And so getting into the cost approach, it's a very, critical part of a strong cost segregation study. And so essentially what this method does is we want to figure out, what does each component of the property worth, right? So, how much would it cost to build this today with modern materials and techniques, right? So think the price of a 2x4 and the cost of the labor to install it, right? And so a good reliable resource that is used pretty universally in the business is a RS Means construction cost manuals. So it's a very, very good resource that is used. We use it. It's always been great. And so the cost approach process, it begins with the total cost of your property, right? Whether it's the purchase price, maybe the construction costs, and we split all of that out across all the components. And so the study must ensure that every single dollar is accounted for and assigned to those three different buckets that we talked about earlier, your section 1245, your 1250, and your land improvements. And so using, the cost approach along with other techniques, like I said, like the unit in place method, really helps a study achieve precise valuations. And so, the accuracy is extremely important for IRS compliance. And, proving that your deductions are based on solid data is really the big thing. And so, after all of that, if you have a study that hits all of those bullet points, then, in the end, you have, a really trustworthy study that's going to maximize your tax savings, and it's going to stand up to any level of IRS scrutiny.
Awesome. Well, so if I to kind of explain this the way that I understand it, as a CPA versus an engineer, and Mark probably hasn't said it here, but he actually comes from an engineering background. That's one of our big differentiating factors with corporate tax advisors is that we have quite a few engineers on staff. I think we've got like 5 or 6 engineers on staff that go out and support a lot of these types of projects. Also the 179D, our R&D section as well. So we have quite a lot of engineers here, and it's always harder for me to understand this as a CPA. So the way that I understand it is we use these RS Means and we use the replacement costs, if you will, with this job costing type of software to get us these. The engineers actually go out on site. They look at what actual materials are there, so that if that's cabinets, they'll classify the amount of cabinets that are there, the yards of concrete, the paving that's outside, specific kind of structures and things like that. They'll classify these things, use the RS Means to essentially figure out what that cost would be from the RS Means perspective. So, that could mean that the RS Means would come up with a value of like 1.3 million, and say 600,000 of that is between the 15-year property and the 5-year property. What you can do with this cost approach is essentially use that as an allocation factor, and you take those percentages that you accrue from that are broken out with these RS Means and this job costing type of software, use those percentages to allocate that against the original purchase price or the actual cost basis of the property. And so that's how we end up determining roughly what 5-year buckets there are, what 15-year buckets there are, and then what the overall structural buckets there are. So that's the way that I understand it, at least from an engineering, from an accounting perspective, and maybe that'll help you guys explain it to your clients a little bit better, kind of in terms of what that looks like. How I was saying before that one of the things that differentiates us is that we do have people with an engineering type of background, right? And that's one of the items that they talk about in the audit techniques guide, specifically construction engineers, the most reliable and accurate cost segregation studies. And those are the ones that are likely to spend less time on an auditor's desk. They're the ones that are performed by construction engineers who actually inspect the property, right? And use actual cost data when available. So that being said, I'm going to go ahead and pop into the next slide. And I know that we have another polling question for you guys.
Poll number 3 has just been launched and will be open for the next minute or so. Again, I'm available in the Q&A if anybody needs any assistance, but please get those answers in for us. Right back to you, Eric.
Awesome. All right. So now we know a couple things, right? We know roughly how much the taxpayers are going to save if they apply this particular tax strategy. We know a little bit about the history and the legislation that surrounds it. We know what makes a good cost segregation study. Now, the final thing here is to go through our list of clients and go, okay, who who does this make sense for then, right? How do we identify the appropriate taxpayers, and how do we plan and utilize this to their advantage? How do we save them the most money possible, right? And how do we make sure that, like I mentioned before, that pesky 8582 in the back there, how do we make sure that that doesn't cause a problem for our taxpayer, and that we can anticipate what that looks like, right? And so, we've talked about like some of those particular things that are allowable for you, and we say that cost segregation allows taxpayers to accelerate depreciation into a current period, right? And I've made the example before here that we've had taxpayers that may have something that's owed this particular tax year, or we're planning on getting are planning on a particular gain hitting in 2025. Say you might have some meetings scheduled for the summer where they're wondering, is there anything they can do, or how much money do they have to set aside for the taxes that they're going to have because they've just sold their business, or they have some other type of thing going on. Maybe they've got some other passive income that is going to hit the bottom line. They sold one of their rental properties, things like that, right? So if we know that we got a capital gain coming, or we got a gain coming somewhere along the line here, and we can fit the passive income criteria, right? We can essentially move that, or maybe we can reclassify it as ordinary, or as an active or ordinary if we got a real estate taxpayer. But essentially, we can use these old historic properties as we're looking through our clients' tax records. We can use these old historic properties and offset that in the current year, utilizing a change in accounting method, right? And utilizing this 481A adjustment in that particular tax year, which is what makes this so impactful, right? And I think we've probably all had that moment where we thought that there was a tax deduction for somebody, and then we realized that we did the counting on our fingers here to try to figure out exactly how old that particular refund would be, and if we had to file an amended tax return, we just wouldn't miss that window, and we wouldn't be able to take that deduction because of the statute regarding refunds, right? And you can only do that up to 3 years old. With a change in accounting method, it's completely different than, say, amending a tax return from the past. You can use a property that was placed in service well past that 3-year time period. And like I've said before, even though this is a timing difference, and as we're trying to strategize this and explain it to taxpayers, even though it is a timing difference, and eventually when you sell the property, you can do a lot of things with this, right? You can couple that with a Section 1031 exchange. So let's say, they're going to have they want to sell the property within 3 years or so. They've just acquired the property, but they've got a tax bill due. They want to see if they can use cost segregation. Well, what they can do is they can do the cost segregation this year, offset that tax, and then they can roll that into a new property that they're anticipating to purchase when they do sell that property in 3 years, using a Section 1031 exchange, right? And say they purchase it for a little bit higher value, they take out a new loan on that, using some of the equity, and so they take out a bigger loan. As a matter of fact, one of our presidents, our current president, may have used this to make a lot of money in the past, right? By continually passing that into a new property or a new future property, taking advantage of the deductions that are available, and then rolling that into bigger and bigger properties, with the hope, and most of us have this hope, is that at some point they will die and they get a step up in basis that when they give it to their kids as an inheritance, right? So that's the ultimate tax planning strategy, right? Is to keep rolling and rolling those properties, creating generational wealth, and then eventually giving it over to your kids, where you get a step up in basis, right? And a lot of the high net worth individuals will roll that in, and then just take out loans on the equity that they've already accrued, right? So they don't actually have to divest of that particular property. So those are all kind of strategies that people use regarding real estate. But I will say this, cost segregation is best utilized with real estate professionals, right? Because of these passive limitation constraints, right? We always have to see if we can get around it with particular methods and stuff like that. If you have a high cash flowing property or other high cash flowing properties within your portfolio, that's a good opportunity to take these passive losses against it, right? So you want to look at, you definitely want to spend a lot of time in the 85-82 making sure that fits this particular scenario. And we at Corporate Tax Advisors, we do a free assessment of what that looks like to see if that will actually work for a taxpayer, right? But like I said, real estate professionals, and the bar is not super duper high. We'll go over what that criteria looks, because we all need a refresher of what that looks like. But that is the best way to go ahead and take that, because you can take that against any active income that you might have. Say you've got another W-2, or you've got some other income that's flowing through for whatever reason. You can take that as an active trade or business income loss, right? Which doesn't limit us, and we're able to take that against any kind of other active income. So the other real big strategy, like I was mentioning before, that the treasury section that allows us to group passive properties. A lot of us have, and if we're looking at our client Rolodex, a lot of us will have, say, a dentist, or we'll have a manufacturer that owns the actual building that they're in, and they do a self-rental thing, and they might have set that up with their lawyer in an LLC in order to ensure that they have limited liability just to the building versus their active trader business. So maybe they've got both of these sitting in different entities. Well, you can use an election there to take these together and offset the active trade or business income, right? And so say we're a manufacturer and we make widgets, and we own the building that we make the widgets in, but we own that in a separate LLC. You're able to take that depreciation essentially against the income for that business by utilizing that particular type of election. So I know I said that we all need refreshers here as to what qualifying as a real estate professional looks like. And, you got to look at how much time the people are spending on real estate versus the other stuff that they do. Right. And as long as they got greater than 50% of all their time essentially spent on real estate, that can get them qualified. You gotta meet a lot of these different parameters. You have to have at least 750 hours of services in real property trades or business during the tax year. And these qualified activities, and this is something that people don't really understand, it can be in a lot of different aspects of real estate, right? So development, construction, acquisition, conversion, rental, operation management, leasing, brokerage. A lot of these particular activities will qualify that person as a real estate as a real estate investor, that allows them to qualified real estate professional that allows them to take these deductions, right? The other cool thing here is that only one spouse needs to meet this in order to take it, and they can take it against the other spouse's active income. So that's a extremely important and crucial tax planning tool. Especially if you've got, say, a doctor that's making $250,000 and the wife is is a realtor, and they own some properties kind of jointly or collectively together, they can end up taking that cost segregation against the overall active income, right? Which is really cool. And then let me see here. I think you want to make, when you're doing these too, you always want to make the aggregation election. So you want to make sure that all these hours that you're looking at are over all the properties that they manage. And in order to do that, you need to make the grouping activities election, right? So most of that will be attached, that most of the time that you'll have to attach that to the tax return there in order to make sure that they're going to meet some of these thresholds that we talked about. And the only time you really kind of have to worry, I believe, about this documentation is if you've got a taxpayer that has a different job. They got a W-2 doing something. Maybe they do software for some reason on the side. That's when you need to make sure that they are preparing contemporaneous time logs and activities so that they can show how they're meeting the 750 hours of service, and that they're greater, and it's greater than 50% of personal services that they offer. So those are the times when you have to prove it. Otherwise, if that's all that they're doing, I mean, there's not a lot that you have to justify with that, right? I mean, essentially, you can say that's the only thing that we do that makes money, and that's kind of how we know we're a real estate professional. And you also need to know that you have to be active versus passive on these. If you're a real estate professional, more likely than not, you're going to be on the active end of a lot of these things. But just to remind you what the active tests are, you just have to pass one of these active tests, right? You have to participate in greater than 500 hours during the year in the activity, and that can be grouped across all of your activities, right? So if you group them together, you meet that 500 hours, because you might not spend as much time on one rental versus the other, right? And so that gives you the opportunity to be an active taxpayer there, which allows you to bypass some of these issues, right? Of course, it's by de facto a passive type of investment. And so you just have to pass one of these particular ones, right? I think it's participation is substantially all participation in the activity, right? So if you're the only one kind of managing it, that can qualify you. If you participate in greater than 100 hours and nobody else that you have that works with you participates more than you, that can make you active. And the activity is a significant participation activity, and total time is greater than 500 hours. And like I said, that's across the board. If you group these together, that's across the board against all the properties. Based facts and circumstances test, and then 5 of the last 10 years, right? And then you've a personal service activity, and you participated for the 3 prior years. So that's the general gist of what that looks like. The other thing I want to talk about is big time commercial guys. Say we own a huge apartment complex, or we own a bunch of commercial buildings and stuff like that. This actually got altered. I remember when I was working for one of those mid-tier tax firms that I talked about in the past, 163J meant a lot different things than it does today due to the Tax Cuts and Jobs Act. It was a foreign interest capitalization requirement, right? That's what I was doing with 163J. But then they changed it all to this Tax Cuts and Jobs Act thing, and they capped the interest expense at 30% of the adjusted taxable income. Well, a lot of people who who own one of these properties, due to the asset base and due to like gross receipts, et cetera, right? I think I put only average annual gross receipts on here, but there's also an asset based test on to what is a small taxpayer or not. So most of those guys will not be considered small business taxpayers. Those guys should make this election so that they can ensure that they're going to be able to take all of their interest expense, especially in the future, right? The only issue with making this election and making the election to not have their interest rate capped is that they must use the alternative depreciation system, right, which increases the amount of life for particular properties. But remember, that's only really the structural one, except for maybe qualified improvement property, which is going to be a 20-year property. The 5 and 15-year property that would normally be classified here, I mean, it gives a different tax years for both of those. But because they would normally be eligible under the bonus provisions, whether or not ADS applies or not, they are still eligible for bonus depreciation. So even if you have these bigger guys and they're using ADS, that will still qualify. We can still get that qualified and still take that bonus depreciation on the 5 and 15-year property. So that's one of the most crucial things to know about Section 163J. I got a lot of text here, so I'm going to cruise through this pretty quick because we're nearing the top of the hour. But I think the majority of these things are not necessarily as applicable to everybody. And we kind of went over these high level already. So I'm just going to go ahead and pass through the majority of that, and we will go to a polling question.
We'll go ahead and get our last poll launched here, Eric. This is our 4th poll. Please let me know if you need assistance in the Q&A, and this will be open for the next minute or so. Right back to you.
All right. So that being said, we need to talk a little bit about what the study process actually looks like, and how, this is more kind of how corporate tax advisors operates this, but this is how the general cost segregation would look. First thing that we would need is some of the initial type of property assessments, like the depreciation schedules that go with the taxpayer. So, I mean, it's going to be a generally high level look at what the taxpayer is going through at that particular point. And if we're worried about passive loss issues, that's a good time to kind of bring this up. But what we do is we call it a preliminary analysis, where we get some of these initial items and then we can give you guys an estimate as to what that really looks like for the taxpayer. So that way you can go back to the taxpayer and say, okay, well, it looks like we're going to be able to save between this range and this range of overall tax liability. So that's one of the things that we do here is we call preliminary analysis as a no cost estimate, if you will, of what that scenario looks like for you. So let's say we've gotten through the preliminary analysis. We kind of know roughly what we're going to get, and we decide, yeah, we're going to go through it with the taxpayer. And so the taxpayer signs an engagement letter, and we go through and assemble a little bit more documentation. So that could be anything from like blueprints, et cetera. Like it depends on what that scenario looks like. But we also schedule an on-site visit, and that's where Mark goes out there, and Mark and his guys go out there and they take a look and see what's all out there, what that property really looks like. And then they take that back and they do their cost estimate magic, and they figure out exactly what that percentage allocation will look like for the cost segregation study. And then they put that all into a nice, tidy final study, and that final study is delivered to the taxpayer, and walk through every step of what it looks like, what's actually broken out, and then what their overall benefit is estimated to be. Of course, that depends on how it flows through their tax return, right? So that's a big part of what we talked about here today. And so we do in stage 3, we kind of do that final delivery, that kind of final study delivery, and then you integrate that into the tax return. For us, we actually include the 481A and the 3115 if we need to do an automatic method change. And then, of course, you always want to stand by your work and what you do, and make sure that when you are questioned or called into question, that you come to bat for the taxpayer. And so all of our studies include audit, defense, up to appeals. And so if they ever get into a sticky situation and the IRS wants to take a look at a particular cost segregation study, we will be there to assist the taxpayer through every step, right? And so that's what we kind of do around here. And I'll go ahead and just open up the floor here. We got about 4 more minutes to our Q&A. I think that was it for the polls, right?
Yes, that's correct.
Okay, well, let's go ahead and take a look and see what kind of questions we might have.
We did have one question. What does personal service activity mean?
That's a very good question. I think it means, let me see here. And I think that was, a personal service activity. I think there's a very specific definition for it. I can give you exactly what that looks like. If we can get some information here, I can get back exactly what that looks like for you. But most of the time it kind of means some type of CPAs are a good personal service activity, right? So we're offering personal services for whatever reason. I think a lot of people have talked about this from an Airbnb perspective. You have to provide substantial personal service activities. Maybe that's, it's not what you might think it is. So it's not like going out there and making sure that there is coffee for people and doing just like the general kind of cleaning and stuff like that. It has to be substantial personal services that are added on top of that. So that could be massage, etc., or say you do horseback riding or something like that, right? So there's got to be some kind of personal aspect in it. Usually when we talk about personal service activities, lawyers, etc., right? That's kind of what they're really referring to when they say that.
And we probably have time for one more question, Eric. Do you recommend this for a short-term rental or vacation home?
Yeah, I mean, it can work really well for a short-term rental or vacation home. And as a matter of fact, that was one of the slides I kind of skipped over. We were talking a little bit about Airbnbs. It really depends on how we're classifying the Airbnb and if they offer that kind of substantial service activities. It depends on how we're kind of classifying that. But if it's in the Schedule E, you can easily take that as extra depreciation. and offset that active income. And a lot of the Airbnbs will have a little bit higher level of income as well. And there's always some splits, if you will, between the personal activity and or other types of activities. So that's usually pretty. I mean, it does work really well. We've seen that work really well for short-term rental ownership. But the cool part is if you can actually get that classified as an active trader business. It really depends on if you can do that. That would be extremely helpful, so that it doesn't get stuck in the passive activity section.
Thank you. And we are just about out of time. Did you have any final remarks before we wrap things up?
No, just if you guys need any help or anything like that, we're always here for you. Like I said, my name is Eric Tuthill, and I'm here with Corporate Tax Advisors. You can reach out to us, and we'd love to hear any questions that you might have. And we'd be happy to do any of these. Like I said, we do preliminary assessments, so we can do estimates of the taxpayer situation for you. So feel free to reach out.
All right. Thank you so much, Eric and Mark. We really appreciate having you with us today. To wrap things up for our attendees, the handouts, archive of the webinar, and CPE credit will be available in your CPA Academy accounts within 24 hours. CE credit for attendees with a P10 on file will be uploaded to the IRS at a later date. And if you look in your email inbox, you'll find the link for the evaluation for this webinar. So please let us know how we did. All questions asked today will also be forwarded in a full report to our presenters as well. Thanks again, Eric and Mark, for your excellent content, and to our members for your participation. Please check the schedule on our website for additional information, and we hope to see you on a future webinar. Have a great day, everyone.
Thanks.